Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video.
Welcome back, everybody. Let's take a look again on the gold market. So today in the fundamental report we have discussed a few recent moments that we've got in relation to the gold markets. First is a rising demand for the physical gold across the world, in Europe and Asia, and the new report from the Goldman Sachs. They suggest that commodities should show great performance in 2023. They suppose that the return might be around 43%, and they explain it with their own invented super cycle commodity action. So also they expect that big rising of the activity in China because of ending of the lockdowns. And there we're trying to analyze it, trying to take a look at other analysis such as the Fathom Consulting. And actually we come to the conclusion that, we see different factors of the possible gold rising. It's not because of some super cycle or China reopening, which is actually, we have the big concern about it. But mostly because of the liquidity drought that we see currently on the markets, and that should remain in 2023. Second, that effect of the rising rate is not seen yet totally. We think that it's lagging for 1-2 quarters. It's more or less visible effect should appear somewhere in the March. And actually the Fathom suggests the same. So when the world standing in let's call it as a global war for actual resources, this is the question of the survival for the Western economy to get the cheap commodities, the raw materials to support existing economy. But other countries do not want to sell their own wealth in prices of the currencies that have to be hardly devalued, strongly devalued. So the commodities should cost significantly higher. And this is the big problem, which should actually last for significantly longer. And since the degree of the certainty will rise with the deteriorating of the economies of the developed countries, which will become evident very soon, we think that should be the major background for the gold demand. That in short what we discussed in today commodity research and gold research. So if you're interested with that, you could read for details and see what particular topics were talked about. And this should be also considered together with the recent analysis of the Fed policy, because this is a cornerstone. This is actually the part of this global view where the actually support to the gold should come. In a short-term perspective, so just to finish the topic of the research, we suggest that the background for reversal here on the gold market will be not in some super cycle, not because of the reopening of the China and so on, but that central banks, we suggest that it sooner rather than later will turn back to the quantitative easing of the policy, because they actually will not have any choice. That's what we suggest. And I do not exclude that the point, if you will just calculate the timing when this bottom has been formed somewhere to the middle of the head, that takes approximately 5 months right there. So if you calculate it right from the 1st November to the right side, we could estimate that somewhere in February or March the right arm bottom should happen. And that particularly the point where we think that Fed should meet the really big problems in the economy, and the problems in the economy should be visible not in the statistics but on the shelves of the stores and the prices and in general in the unemployment rate. So it will be absolutely evident. And rising of the gold probably will start, not because of the, as I said, supercharge of the super cycle somewhere in the commodities by the Goldman Sachs analysis, but just because Fed will have to use the rate, start cutting the rate. So with the actual inflation will remain approximately the same level, around 5.5, I suppose, 6%. So we think that this will be the major background. In the short-term perspective, we are still going with this pullback, with this retracement, and we suggest that the monthly Brent band should become the part of this rally, or better to say not rally, this collapse. And currently we're just searching for possible position taking. So actually we already have got the one last week when we talked about free drive pattern and so on. And currently we could get another one. So on the daily chart we have, well, actually market is forming few bearish patterns. We have the divergence, trend turns bearish, we have the butterfly sell stands in place, we have sharp reversal forming the reversal swing to the downside, big evening star candlestick pattern, and all this stuff is happening right around the potential neckline, which is really great. On the lower time frame we have free drive that still stands in progress and it hasn't completed minimum target. And the cross-market analysis that we did yesterday shows that gold market probably also should keep going lower, just because on the dollar index we also expect some more strength, at least to the minimum targets that we have based on the same free drive on the dollar index, based on the grubbers that have been formed there. In the longer term perspective, as on the gold, as on the dollar index, we also have the potential bread and butter on the monthly chart. So it means that here we should get some continuation. Here's as well, you can see the divergence. And take a look on the hourly chart, the retracement that we discussed. Here we actually had previously two confluences, and we said consider one or this one or next confluence. There's more probable areas where a market could show the retracement. And take a look now, market has reached the confluence area, completed A, B, C, D, XOP target, almost completed. So some spikes here might be on Monday. That's actually an area that seems currently interesting for possible taking the short position. So at least you could think about it, consider this area that in general relatively strong resistance. You do not need to hide and place too far stop. So it should be somewhere above the XOP should be enough. And in general, the overall nature of the bearish market that we have currently suggests that this will be absolutely natural area for establishing of the downward action. So let's see what will happen on Monday.